In 2024, the S&P 500 was a rocket ship, soaring over 25%. But the latest 2025 Dalbar data reveals a brutal, uncomfortable truth. The average investor managed to trail that exact same market by a massive 8.48 percentage points. How? You aren't losing to the market because the index funds are broken. You are losing because of your own behavioral psychology. You are quietly sabotaging your own wealth. By the end of this video, you won't just understand the psychology gap that is draining your net worth. You'll have a concrete 5-step firewall to permanently protect your portfolio from yourself. Here are the 4 behavioral mistakes turning your passive investing strategy into an active disaster. Let's look at an objective case study of a totally normal investor. We'll call her Elena. Elena's ultimate goal was simple: long-term wealth preservation and early retirement. She wanted to aggressively fund her accounts now so compounding interest could carry her the rest of the way. She did everything right by the textbook. She ignored the crypto hype, skipped individual stock picking, and steadily funneled her $300,000 nest egg into a broad S&P 500 index fund right around late 2021. She felt entirely secure. She had sidestepped high-fee advisors and embraced the low-cost passive revolution. She thought the hard part was over. Then, the 2022 macroeconomic shift happened. Inflation spiked, the Federal Reserve started hiking rates, and a brutal bear market took hold. Month after agonizing month, Elena watched her portfolio slowly bleed from $300,000 down to $220,000. She kept repeating the mantras she knew: stay the course, buy the dip, zoom out. But knowing the math is completely different from stomaching the psychological torture of a real-life drawdown. In October 2022, right near the absolute bottom of the market cycle, Elena's behavioral limits broke. She panicked. She sold everything. She moved her remaining $220,000 to a high-yield savings account, vowing to jump back in only when the economic dust settled.
By the time the headlines turned positive and she felt emotionally ready to re-enter the market, it was mid-2023. The AI boom had already fueled a massive new bull run. She bought back in at roughly the exact same level she had sold, except now she had $220,000 instead of $300,000. Her index fund had done exactly what it was supposed to do. It endured the bear market and recovered. Elena was the one who failed. She made the single most expensive mistake in investing. She sold low, locked in her losses, and then bought high when her emotions finally calmed down. That decision cost her $80,000, money that will never compound, will never grow, and will permanently delay her early retirement. This brings us to the first devastating index fund mistake: the psychology gap. There is a massive illusion at the heart of the modern passive investing movement. People confuse a straightforward set of rules with a painless emotional experience. Think of it like deciding to run an ultramarathon. The instructions couldn't be more basic. Just lace up your shoes and keep putting one foot in front of the other. The mechanics are incredibly simple, but surviving the physiological breakdown, the blisters, and the mental exhaustion of the actual race is brutally difficult. Buying the fund is just lacing up your shoes. Holding it through a market crash is the ultramarathon. According to research from Dalbar, a massive financial research firm that studies investor behavior, the average equity fund investor consistently underperforms the very funds they invest in. Let that sink in. The fund makes money, but the human holding the fund loses out. Over 20 years, the average equity investor trails the market by 1.2% every single year. For fixed income investors buying safe, boring bonds, it's even worse. They trail by 3.3%. Why? Because of the behavior gap. That sounds complicated, but simply put, it means your human brain is literally hardwired to do the exact opposite of what makes you rich. It means you snatch defeat from the jaws of victory by buying in when everyone is greedy and optimistic, and panic selling when fear takes over. On a $500,000 portfolio over 20 years, a behavior gap penalty translates to roughly $400,000 in lost wealth compared to simply holding the index. The fund did its job. The human did not. Reading about the 2008 crash or the 2022 tech pullback and actually sitting at your desk while your 401k bleeds out are completely different psychological universes. The solution to this isn't reading more finance theory. The solution is pre-commitment, which we will build in a minute. Now, let's pivot to the second mistake, which is obsessing over the wrong numbers and falling for the illusion of cheapness. Index investing became massively popular largely because of the dramatic fee difference between index funds and actively managed funds. Brokerages love to market ultra-low expense ratios. An expense ratio, that sounds complicated, but simply put, it means the annual subscription fee the fund company charges you just to hold your money. A standard S&P 500 ETF charges an expense ratio of around 0.03%. That means you pay just $3 a year for every $10,000 you invest. Some brokerages even offer zero-fee funds that charge absolutely nothing. This is an incredible win for regular people. But here is the sick irony of behavioral economics. You will spend days obsessing over saving $3 in fees, and then you will completely ignore the tens of thousands of dollars you lose to your own bad behavior. You are tripping over dollars to pick up pennies. What good is a 0% expense ratio if you get spooked by a 5% dip in the S&P and move everything to cash at the exact wrong time? But there is a darker side to the fee conversation too, because the financial industry knows you want simple. So they package up simple index funds into products like target date funds or robo-advisors. A target date fund, that sounds complicated, but simply put, it means a mutual fund that automatically moves your money from risky stocks into safe bonds as you get closer to your retirement year. It sounds perfectly convenient, but target date funds are usually what we call funds of funds. They hold other index funds inside them, and they often slap a massive layer of secondary fees on top for the convenience. A target date fund might charge you an overall 0.50% expense ratio for this automatic rebalancing. That doesn't sound like a lot. It's 0.5%. Who cares, right? You should care. On a $400,000 portfolio over 30 years, assuming a 7% return, that tiny little 0.5% fee will cost you roughly $165,000 in lost compounding wealth. You're paying 6 figures for a service you could replicate yourself with 10 minutes of clicking on a Tuesday afternoon. If you truly need the hand-holding to stop yourself from panic selling, maybe that fee is worth it to save you from your own brain. But for everyone else, it is a quiet, devastating drain on your net worth. This brings us to mistake number 3, the concentration trap. When most people say they are an index investor, what they really mean is they bought an S&P 500 fund. And when you buy the S&P 500, you sleep like a baby because you think you own 500 equal slices of the largest American companies. You think you are perfectly diversified. Wrong. The S&P 500 is a market cap weighted index. That sounds complicated, but simply put, it means the biggest kids on the playground get to hog all the playground equipment. The larger a company's total value, the larger the slice of your money they take. Right now, the top 10 companies in the S&P 500 make up roughly 30% of the entire index. The famous tech megacorporations account for nearly all of the index's gains in recent years. Do you realize what this means? Your beautifully diversified, totally safe index fund is actually a massive, concentrated bet on a handful of Silicon Valley companies. If tech stumbles, your supposedly safe retirement stumbles right along with it. Now, you might be thinking, well, those companies are huge because they've been enormously successful. The U.S. stock market is a money-printing machine. Let me give you a terrifying historical case study. In 1989, Japanese investors felt invincible. Their economy was booming. Their stock market index, the Nikkei 225, was dominating the globe. It was heavily concentrated in massive banks and industrial giants that everyone honestly believed would rule the global economy forever. Does that sound familiar? The Nikkei hit an all-time high of nearly 39,000 points in December 1989. Do you know when it finally recovered to that exact level?
2024, 35 years later. If a 30-year-old Japanese worker put their life savings into a domestic index fund at the peak, they would have had to wait until they were 65 just to break even. A lifetime of wealth accumulation, utterly destroyed by concentration risk. Now, the U.S. market is not 1989 Japan. We have deep structural advantages and a totally different corporate culture. But the lesson of behavioral risk is crystal clear. True diversification means your portfolio should be able to survive scenarios you cannot even imagine. And a portfolio concentrated 100% in the S&P 500 is only optimized for the scenarios where large-cap U.S. tech companies do well. True diversification means owning international stocks. It means owning assets that might actually be performing poorly right now, because the point of diversification is that something in your portfolio should always be working when everything else goes up in flames. And that brings us to the fourth, and perhaps most important mistake, the systemic failure that underlies all the others. You are treating index investing as a truly passive activity. The financial industry has sold index investing as a set-it-and-forget-it easy button. This framing is dangerously misleading. Yes, index investing eliminates the need to research corporate balance sheets. It eliminates the need to time the market. But it absolutely does not eliminate the need for emotional regulation. It does not eliminate the need for patience during drawdowns or discipline during euphoria. There will be long, agonizing periods when your boring index fund underperforms some other strategy that looks obviously superior in hindsight. During the massive tech or crypto bubbles, staying the course requires active psychological effort. You have to make a continuous, painful decision not to abandon your strategy, not to convince yourself that this time is different. That is not passive. That is an active, ongoing, emotionally draining commitment. The research on this is completely unambiguous. Fidelity once conducted a massive internal review of their best-performing accounts to see what kind of investor got the highest returns. Do you know who won? People who had forgotten they had accounts, and people who were literally dead. The dead people outperformed the living. Why? Because the dead people could not intervene. They could not panic. They could not turn on the financial news, get scared by a talking head in a suit, and liquidate their life savings at the exact bottom of a recession. Your biggest enemy in index investing is not expense ratios. It is not fund selection. It is you. Your fear, your greed, your impatience, and your overconfidence will cost you far more than a bad economy ever could. So what do you actually do with this information? How do you fix a system when the broken part of the system is your own brain? You need to implement a 5-step firewall between your money and your emotions. Step 1. Stop the tinkering through automation. If you have to manually log into your brokerage account every 2 weeks, look at the current price of the market, and manually click buy, you are giving yourself twice a month to second-guess your strategy. You're giving your fear a steering wheel. Remove yourself from the decision loop. Set up automatic investments. The money leaves your checking account and buys your index funds before you even notice it's gone. Step 2. Pass the boredom test. Successful evidence-based investing is basically like watching paint dry. If your heart is racing when you look at your portfolio, if you are checking your brokerage app while sitting in traffic, you are doing it wrong. You have to reframe your mindset. Boredom is not a sign that you are missing out. Boredom is the beautiful, quiet sound of your wealth compounding. Step 3. Audit your hidden costs. Before you put another dime into a fund, search for its expense ratio. If you were paying 0.50% for a packaged target date fund, seriously ask yourself if you are willing to lose 6 figures of your wealth just to avoid spending 10 minutes a year rebalancing your own portfolio. Use ultra-low-cost direct index funds. Keep your money in your own pocket. Step 4. Broaden your horizons. Look at your portfolio right now. Are you 100% in the S&P 500? If so, you need to acknowledge that you are making a heavily concentrated bet on American mega-cap tech. Consider a total world stock market fund. Consider international exposure. Build a portfolio that doesn't just maximize returns in a perfect scenario, but one that actually survives and recovers in the worst-case scenarios. And finally, step 5, pre-commitment. You need an evidence-based mindset. Right now, while the market is relatively calm and your head is clear, write down your investment policy statement on a physical piece of paper. I am investing in these specific diversified low-cost funds. I will hold them for 20 years. If the market drops 30%, I will not sell. I will buy more. Sign it. Date it. Put it in your desk drawer. The next time the market plummets, pull out that piece of paper and reread it. Let's bring this all together. You are fighting a quiet behavioral war on 4 fronts. You have the psychology gap tricking you into panic selling.
You have the illusion of cheapness, where hidden fees drain your compounding engine. You have concentration risk blinding you to global realities. And you have the dangerous myth that passive investing means turning off your brain. The ultimate goal here isn't just to beat an arbitrary benchmark or have the highest score on the spreadsheet. It is about taking your life back. It is about reaching a point of absolute financial independence where your money works harder than you do. Your success depends entirely on getting out of your own way. Your greatest weapon against poverty isn't a Wall Street trading algorithm. It isn't a secret stock pick from a guru on the internet. It is your ability to sit on your hands and do absolutely nothing while everything around you feels like chaos. So here is your grounded real-world next step for today. The minute this video ends, log into your primary investment account. Check your expense ratios. Look at your actual asset allocation and see if you are secretly betting your entire life savings on just a handful of tech companies. Set up your automated monthly deposits. And then, close the tab, go for a walk, live your life, and do not look at that account again until next year. Are you an investor, or are you just a spectator sabotaging your own growth? Stop tinkering, stop guessing, stop investing based on your feelings, and start following the plan.